Most people think getting funded means walking into a bank and asking for a loan. That's not how I look at it anymore. I look at funding like a sequence, a strategy, a system. And if you understand the sequence, you may be able to access serious capital through 0% business credit card without approaching funding the way most people think you have to. And what most people don't even understand is what a 0% offer actually is, or how much access is really available out there. So today in this video, I'm gonna break it down. So first, what is 0%? A 0% introductory offer is when a bank gives you a promotional period. But within this period, you do not have to pay interest on purchases or sometimes balance transfers depending on the card. That's it. That's the structure. And here's the part that most people miss. This is what happens when your credit becomes strong. Banks start marketing to you. You'll start getting approved offers, pre-qualified offers. You'll start receiving all types of mail and emails from these institutions promoting their products. And many of these approvals may be income stated. And what do I mean by income stated? You're able to state income rather than submitting heavy documentation up front. That surprises people, but it's real. Why would banks give away money at 0%? Simple. They're competing for customers. They need your money. They want your relationship. So they use these incentives. 0% is an incentive, just like cash back, travel rewards, hotel points, miles. And if you've ever wondered how people are traveling more, or staying in hotels, flying more than expected, a lot of that is tied to credit reward systems. Banks reward usage. But understand, they're doing it because they want your business. Now here's what most people don't realize. There's a lot of institutions out there offering 0% introductory credit products. I mean a lot. I mean far more than people could even imagine. We're not talking about just Chase or Bank of America and everyone's favorites. There are major banks, yes, but there's also regional banks and credit unions. There are so many institutions competing for strong borrowers. People think access is limited, but in all reality, positioning is what's rare. And once your profile gets strong enough, these offers may start finding you, not just you finding them. That's a shift in thinking. Now, let me be honest, 0% credit can be a game changer, especially for everyday people. People that's trying to start a business, invest, build something, create income, create opportunities. Because let's be real, saving $20,000 from a regular 9-to-5 job could take years. After rent, bills, food, life, that's tough. That's tough. But what if access to opportunity didn't depend only on savings? What if it also depended on positioning? That's why this matters, because access changes everything, right? Now, nobody taught me this growing up, man. I'm not mad. And I know there's plenty of people out there that's like me that could relate. Most people around me use credit in its lowest capacity: to get a house, to get a car, to use a card in emergency, to carry debt, but not to build. Most of us were taught how to consume with credit, but not how to evolve with it. Consumer mindset buys things, builder mindset builds things. That's a major shift. Good credit is not just for buying things. It can be a tool for building things. But hear me, nothing in life is free. 0% does not mean free money. It means temporary low-cost leverage. If you treat it like income, you can drown. But if you treat it like a tool, you can build. Now let's make this real. Say you get a $50,000 credit card at 0%. Your minimum payment might be around $500 a month. Now that is access to $50,000 for a payment similar to a car note. Or maybe you get $20,000. Your minimum payment might be around $200 a month. Just think about that. That's real leverage. And for someone trying to start something, that can change everything. One reason I favor business credit cards is because many major business credit cards often do not report utilization to personal credit, same way consumer cards do. Now that matters, because if you max out a $50,000 business credit card, that balance will not impact your personal utilization in the same way. Now that can protect your score during funding. That's huge. Now let's talk structure. Funding is rarely one approval. It's often a sequence. It's usually centered around 0% business credit cards, sometimes business lines of credit, occasionally other forms of capital. That's how getting funding gets maximized, not one product. Layered access, capital stacking. Now, I may start with Chase because sequence matters, right? Banks don't just look at your credit score. They look at inquiries, exposure, utilization, account age, internal risk models, behavior patterns. And Chase has internal rules like the 524 rule. If you've opened 5 or more personal credit cards in 24 months, that may impact your approval. And Chase can sometimes offer strong limits, $25K, $50K, and sometimes more. And in some cases, multiple approvals may be structured strategically. One pull, more than one result. Every bank has internal systems. They don't all speak the same language. Each institution has its own data points, like risk models, exposure thresholds, bureau preferences, approval algorithms. It's not just a yes or no. It's calculated. Here's an advanced move. Security freeze strategy. Now, if you freeze a bureau and then you apply for credit, if the lender attempts to pull it, the application may stall or deny. And the adverse action letter may reveal which bureau they tried to access. Now you're collecting intelligence, not guessing. Now that's power. That's also why I built bureau pool resources, because sequencing by bureaus matter. An inquiry is like a radar ping. So every time your credit gets pulled, it sends a signal. One signal is normal, but too many signals in a short period of time suggest aggressive pursuit of credit. And systems notice that. That's why inquiry timing matters, and why inquiry cleanup between funding rounds can matter. It can help quiet the radar before the next sequence. Now that's positioning. Years ago, people used what was called the shotgun method. That's where you would open multiple tabs on your computer and submit multiple applications. Submit it quickly across different institutions, trying to move faster than reporting systems updated. I'm not telling you to blindly do that. I'm teaching you how timing and reporting once influenced strategy. There's a difference. Now after Chase, maybe I'd go to PNC and then Bank of America, then other institutions. The goal is not random applications. The goal is sequencing, layering approvals, building capital exposure strategically. Now this part is huge. Let's say your 0% period ends and you're not ready to pay the balance off. Many times, you may be able to transfer that balance to another 0% card. And now you may have extended your runway another year, maybe more. That alone is a game changer. And some people may repeat that strategy again. That is how time is created with capital. Now, I have a client that I helped secure $30,000 about 2 years ago. And today he's still actively managing that capital. In some cases through balance transfers, potentially for the third time. Why? Because even at $300 monthly payments, you are not paying off $30,000 in 1 year. Now that's obvious. The point isn't speed. The point is control of time. And during that time, that capital is working. That's strategy. But hear me clearly. This only works when funding meets discipline. If you treat leverage like income, you can drown. If you treat leverage like a tool, you can build. Nothing in life is free. 0% is not free money. It is temporary leverage. I've helped many clients access capital through strategies like this. And what separates strong outcomes from weak ones is rarely luck. It's sequencing. It's position. It's discipline. Good credit is not just for buying things. It can be a tool for building things, but only if you think like a builder. If you want my bureau pull list, inquiry templates, and deeper breakdowns of funding sequences, check the links below. And common funding sequence if you want a part 2. And don't forget, do the right thing. Yeah. Subscribe to my channel. Make sure you like this video.